This conference will now be recorded.
Good evening, ladies and gentlemen. This is Clueless Day Trading Frank. It's approximately 7:58 p.m. Eastern Standard Time on May 20th, 2019. This is a quick and hopefully brief strategic market and stock update webinar for all members and free trial subscribers at Clueless Day Trading, as well as for anyone out there who has internet connection to visit us at Google, at our YouTube channel at Clueless Day Trading, the Google YouTube channel, and access these fantastic free resources for their own benefit and understanding the dynamics of these extremely volatile markets and some of the reasons behind it and what to do about it. Full disclosure, this is purely for financial education and not for any solicitation or advice. The session will be recorded and uploaded to the Google YouTube channel, as mentioned earlier. On that note, let us begin. What we're going to try to attempt to do today is go through a series of charts, both short-term and long-term, and try to get a feel and a projected forecast of what the markets, where the markets might be in a couple of days from now, and maybe a little bit beyond. I do not need to remind anyone that these are probably one of the most difficult markets that anyone can trade in because of the extreme volatility, both up and down, with a short-term overall bias being down. However, intraday, as you can see here behind you as I'm speaking, this is a 5-minute E-mini chart, S&P futures 5-minute charts. Each of these candles are 5 minutes, obviously. And you can clearly see that despite the pullback and the drawdown from the, this was 4:30 in the morning on Sunday, Monday 4:30 in the morning, well, overnight, Globex futures, we came down hard at 9:30, and you can clearly see here what happened during the day, and this is where we are right now with futures up roughly 7.5 points. So the point that I'm trying to make here is that it is not, regardless of what you might think or what you hear all around you, or if you're an active trader, you know it. But regardless of what you think, this is not a straight line down and a straight line up. In that particular case, we would just simply buy a whole lot of puts or hedges, as we call it, SPY puts or QQQ puts or IWM puts, whatever the case may be. We primarily use the SPY puts for market hedging purposes, long and short, and we just sit back and make money. Well, it doesn't work like that. You buy puts, and as I'll show you today, it gave us roughly a 25-minute or maybe an hour or less window where you could have made maybe 30% on it intraday, and then you would be down as the market surged at the end of the day in the last hour. Just the nature of the beast. That's what algorithmic high-frequency trading-driven markets are. So a couple of big points. We all know that we have the current status quo with the trade war continuing between U.S. and China. Nothing new there. There was retaliation by the U.S. against, there was Chinese retaliation last week where they said, they came back with more tariffs. Then we had the U.S. clamping down real hard on export ban and import ban from Huawei. That's China's, I think I'm pronouncing it correctly, that is China's largest telecom company, one of the leaders in the global leaders in the 5G technology. And that obviously caused a massive negative reverberation in the US and global markets as chip suppliers who use their products or sell to them fell dramatically. We saw that throughout the markets today. And obviously that's something that was a very heavy downward pressure on the markets from companies like Apple to Nvidia to Qualcomm to Xilinx to Broadcom, AMAT, all chip companies primarily pretty much fell real hard. Broadcom was down 6%. They do a lot of business, they buy from China as well as sell into China. So obviously That was a serious blow. According to the Chinese, we're basically trying to shut down one of the largest companies. It's like the Chinese trying to shut down one of our largest companies. So that's the way they feel about it. Well, that's what trade wars are all about. However, we shall see what happens. So saying all that, that was one particular matter. There was, and this is going to be an ongoing situation. So what I'm trying to get at is that unless we have some sort of resolution or some sort of moderation, as we had seen in prior weeks, where there was some conducive, helpful talks between the Chinese and the U.S. delegations, and there was some meeting of minds. Well, all that seems to be thrown out right now. However, keep in mind that not everything is broadcast for the in public. There are talks continuing underneath the surface, and do not be surprised if we hear something massively positive come out that and at this point, Treasury Secretary Mnuchin or Lighthouser, our trade negotiator, Ambassador Lighthouser, that they will be traveling to Beijing. That could just come out from nowhere. They could come out overnight. Futures could be up 20 points on that. So these type of things, just be ready for it. We are in extremely volatile times, and I don't need to remind anyone. And from an active trading standpoint, if you are not actively trading the charts per se in order to manage your tactical profits, then you are going to be in serious trouble. This is a very frustrating market. I am frustrated. I have talked to some of my old colleagues on Wall Street who are senior guys, as well as some younger guys who are extremely skilled in what they do on the trading side and the portfolio management side. They're just very frustrated. They actually, they don't know what the heck they need to do. And this is something which is a common thing across the board. They cannot fully short the market in a big way because you get these big moves up, and then they can't sit down there and just buy their choice stocks, because then you get these type of situations where every single major chip stock falls apart. Okay, so market is in a limbo. There's no question about it. On that note, what we will try to do here at Clueless A Trading is we are going to go ahead and try to show some short-term and some longer-term charts on what I can see. Again, keep in mind these are very fluid times, and unless you are dealing with the fluidity of the charts, this is not easy. All right, let me just put it this way. It is a very exhausting day for me. I didn't expect anything else, but I will tell you, it is very mentally exhausting, and the charts are the only thing which keep me somewhat sane in what I attempt to do here. So on that note, let me let me show you quickly. The other thing to keep in mind, and this is something that you all know, but I'd like to remind everybody that we're basically trading against the machines. That old term, like rage against the machines. So these machines they move so fast, so quick, that you might get a window of maybe 10, 15 minutes to get out of a position or less on a profitable trade, and before you blink, boom, it comes down. Okay, and these are primarily for intraday trades, but even on swing trades, you see a big move up, and then you get a small window. So from an execution standpoint, you need to take advantage of that window that's open to get the price that you're looking for from the exit front. So this, you just got to deal with it. There's nothing we can do about it. That's the speed of the machines, and we are basically fighting them for not for dominance, but we're fighting them on to place some sort of equal footing. As we can clearly see here, we were up about 7 when we started the session. Now we are pulling back. We are down about. We're not down yet, but we're futures are up about 3.5. It really doesn't matter. You can see it in the charts. So this is your short-term chart. This is a Fibonacci retracement. And this week, going into Memorial Day weekend, next Monday, we have to be following these charts very, very clearly if we're going to make at least some money on intraday basis or a intra-week basis. Okay, so this is it. Nothing more to show. This is your Fibonacci retracements: 23.6, 38.2, 50 fib, which is generally serves as a magnet, as a support or a resistance on impulsive moves down or up. You can see that. That's why it's in blue dotted line. We have the 61.8 fib retracement, we have the 78.6, and then we have the pattern completion, the short-term pattern completion at 28.87. You can see that clearly drawn out. So if somebody, the bulls will basically say, look, that's a large, change the color of this thing here. The bulls will say, hey, look at this. We have this is a W formation, and after we zigzag our way up, we're going to go all the way to 28.72. That's roughly 30 S&P handles here, E-mini handles, multiplied by 6 or 7. That's a 200-point move from here, from where we are right here to here is a 200-point, 200-point Dow Jones Industrial move, 200 plus. That'll be the bullish standpoint. The bears will say, hey, look, we have head and shoulders all over the place. You have a head here, you have a left shoulder here, you have a right shoulder here. Okay, and then we have that neckline support right there at 28.32. So there are different ways you can interpret, the different patterns being played out within the same framework. On a larger front, there is a big channel. This is a channel, and if you're looking at a channel trade, then the upper end of this channel intersects here at the 50 Fibonacci retracement at around 28.58, 28.60. So this is the level that we have to watch for when we're trading tomorrow as to what happens at this level. There is obviously, and you can clearly see that from my charts every single day, that each of these levels that are marked from a tactical, technical perspective are hit, met, pulled back, broken up. It breaks out from there, and it's just, it's just the way it is. That's how machines operate. So that's your shorter term chart on that, and of course you can use that to project to see what happens intraday and on a swing basis. The next one is a similar chart. This is a 15-minute. This goes back to the big gap down open back on the 5th of May, and the 5th of May was the Friday. Well, 6th of May actually was Monday 2 weeks ago. The big gap down. Okay. So since then, if you look at it, we have gone through extreme volatility, with the range right now capped at 2,900, 28.99, and the bottom end of the range is roughly 2,800. So in effect, in simple terms, we are operating in a zone of 100 S&P points. We are operating in a range, I should say, of 100 handles on the E-mini, 100 S&P points, make it simple, plus minus. Okay, and upper end is 2,900, lower end is 2,800. This is the zone the market's operating in. Individual stocks within the zone fluctuate very rapidly. A 600 point, so 100 S&P points is roughly approximately 600 to 700, I would say 700 Dow points. That's the range here, plus minus, and you can clearly see here that we have a lot of zigzagging. So right when you think the market's going to break out over the 2,900 zone, boom, the sell programs come in. There is really no suggestion. I don't advise, from a suggestion standpoint, is that as you're getting close to each of these levels, and that's why you got to focus on these charts. Okay, you got to basically take down whatever profits you have, and you might want to short on an intraday basis some of the breakdowns that you can clearly see here. But those breakdowns in general, from what we can see, a lot of the damage happens overnight on the Globex markets, in the global futures market, and then as our markets open, you start to see a recovery. So from a shorting standpoint, you got to be quick on the draw, and otherwise they're just going to take it away from you. So somebody from the outside who doesn't understand the technicalities of the market, like, oh my God, the market's on a one-way trip down. As you can clearly see here, there is no one-way trip. There is a lot of zigzagging. That itself causes massive volatility. That in turn causes massive frustration for all of us. And there is no big happy smile, despite some big winners on individual stocks and such that we have delivered to our members. We're going to look through that towards the end of this session. So that's it. So this is where we are. There's your range. You got that big, I color coded as much as I can, so it catches your eye, catches your, draws your attention, and you can see here that 2800 level. You can see here the 2900 level, and this is where we are right now. There's a color coded section here. This is a section. This is a part which I consider to be bullish if the market can break out over that, and that is 2858 to 2870. This market is all about trading numbers, ladies and gentlemen. It's all about trading numbers, and I know every one of you know, but it is my duty and responsibility to remind everyone over and over again, as I like to remind myself over and over again. It is all about trading numbers. That's it. Numbers, patterns, levels, ranges, and that's it. So that's your picture on the 15-minute chart. Let's move on to the next one. The next one is a simple one. This is more of a swing trade, even though one can use it certainly use it as a day trading chart. This is the S&P 500 futures, 60 minutes, 1 hour. I've color coded it where we are neutral zone, and this is between now and the end of the week, in my opinion. Generally speaking, 90% plus of the time, we get a up 48 hours prior to Memorial Day weekend. Just the way we got that before every other holiday weekend, per se, whether it be Mother's Day, whether it be Thanksgiving, whether it be, in this case, Memorial Day. Okay, so bottom line is that you get these invisible hand of the market, what they used to call the plunge protection team, and they want to make sure that we don't get and the only time it was different was on Christmas Eve. The Christmas Eve massacre wasn't just a term that I coined. It was a term that they coined in the media too. Was very different when the market plunged 700 points on Christmas Eve. That is normally unheard of. So barring that massive black swan event in 2018, December 24th, what we're looking at here is going into Memorial Day weekend. So it's this chart, what can I say? It's the simplest one and the most effective one you guys can use to get a directional bias on the market between now and end of the week. Okay, so you got the neutral zone here between 2840, 2860. You got the red zone here. I would say bring it down a little bit, 2835 to 2861. So that's roughly about 180 Dow points or so. And then you got the red zone where things just plummet, and that would be below the 28. I would say that's below the 2833 level. It's color coded. You guys can see that. Okay, you can replicate this chart quite easily on investing.com. One of the easiest platforms to use. One of the platforms that I use for my charting, as you all know. Then we have the bullish, and then right here is 2800 again. 2800 is a technical as well as a psychological support level. 2900 is a technical and a psychological support level. Okay, and so this is a 50 Fibonacci retracement. You can see that that's 2880. So above that, if we break above the Fibonacci retracement or we break above this uptrend line, you can see that. I don't need to explain the obvious. You can see that right here, right there. It's right above the neutral zone that's indicated here in yellow. You get that green move, which would be something like this. So if the market does what it does, given this volatility, this was that big 400-point move on the Dow. Beautiful technical formation. And then bang, straight down. it didn't happen like this back in the days. I mean, there was always volatility, but now it's just like bang, just happens. So and it was an overnight gap open down, straight down towards 2800, came up, started creating a zigzag a complex W pattern, as you can see, and then bang, straight up. This was on the 16th, last Thursday. We managed to catch a good bunch of these moves, as you know, based on my charts, and I know some of you do. But again, what I want to remind everybody, these are things I learn every day, things I've learned, things I try to apply, things I try to apply every single day. Do not get overexcited, and certainly do not get over despaired. Okay, I'm kind of made up a word. Oh, not over despair, but don't get overtly bearish, and certainly don't get overtly bullish. This is a technically bullish or bearish market within all these ranges, all this stuff that I'm explaining to you right now. So just try to keep as calm as possible. When you feel like complete crap, look at the charts and see whether you want to enter a small trade. Because that small trade could be a 200-point mover on a vicious move that comes from nowhere. It is not in our control that we can control what President Trump is saying or doing. It is not in our control to what the Chinese premier, he doesn't actually say much, but what the Chinese media is saying, or what's coming out of there, what retaliation they're doing. It is not our job to be political traders. It is our job to be technical traders. And like I said, I spoke over the past couple of weeks and last week to some of my ex-colleagues, and those guys are flabbergasted. They don't know what the heck is going on. And they're smart. So this is not just, that's what's going on out there, okay? So, so bottom line is, that's it. You got the color-coded system here. Use this chart. I'll be showing it throughout the day, throughout the week. Replicate it yourself, and you can see that, okay? Bear with me 1 second. Okay, I'm back. So let's make good use of this time. So bottom line is that if any of us, that includes me, we all want straight out answers. We want to know: are we going up? Are we going down? Well, I can tell you, we're neither going up or down. As we look at the longer term charts, we can make up our mind. But whenever we make up our mind, it's going to go the opposite way. That I can guarantee you. Okay, so because the majority out there are sitting on cash, I'm talking institutional hedge funds and such, they are certainly not overexposed to stocks. They're getting clobbered by these big sector moves that's happening on the semiconductor chips, for example, which were doing fantastic just a week, 10 days ago or less. So that's that's just the psychological aspect of the market. We all want easy answers. There are none. There are selectively good answers on certain stocks, which you're going to look at, like United Health, like some of these other specialty stocks that we trade. But aside from that, when it's the overall market, this is the picture. So fine, nothing more to say other than to say when these stochastics get overbought, they generally tend to pull down. Market gets a pullback. This is each of these candles are 1 hour, so you have a little bit of room to operate. Instead of those 15-minute candles that zigzag around like fireflies, this one has a little bit more symmetry to it. And of course, overbought, oversold conditions are constantly happening because that's what the machines are doing. Buying it, within a range, selling it on the upper end of the range, buying it again at the bottom of the range, and that is the picture the roadmap that I produce, so all of you can do what you need to do. Very, very helpful charts. So this is it. Arrows put in place, very defined, and we shall see. There are multiple inverse head and shoulders and head and shoulders in play simultaneously. Since this is the month of May, this chart is basically the month of May. You can see that, and you get W's, you get M's, you get W's. You can clearly see what's going on. It's all W's and M's, right? And that is what head and shoulders are all about. Okay, so please focus on this chart, color coded, and this is basically what I'm looking at for this week. 2,900 on the upside, 2,800 on the downside, and this is my conclusion to this particular chart. I think both sides are going to be met. How about that? Between now and Friday. All right, so get ready for it. Get ready to, work, and hopefully you have some time in your hand to operate in this work zone. So I repeat again, 2,900 will happen in my opinion. 2,800 will happen in my opinion this week. So you got a big white swing in play, and we are right here in the middle with futures up about 6 points. Okay, next one. It's pretty much nothing to say on this one. This is your S&P 500. This is not the futures chart. Same story. You got the S&P 500 all the way from the 8th of. This is going back a little bit more to get a bigger picture. This is from the 8th of March, March 8th, right there, when we were at 2,700 at that time, 2722. We had a big surge on the 8th of March, and came all the way up here with lots of volatility. You can see that clearly. This chart helps me keep balanced because it gives me a picture of where we are over the last couple of months. This is where we are. The pattern, wider pattern you can see here is, so the bulls will say, hey, that's a dragon bullish W. This is a complex W. We're good to go. Low end of the scale is a gap here at 2830, and we're going to basically move higher and go towards filling this very large gap that I showed many times. And if we didn't have this constant barrage of tit for tat tariffs and China retaliating and comments and blah, 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 well, that's the nature of the trade war, I guess. Nothing we can do about it. We would be right now at around, in this gap here, at around 2920, 2930. But that's wishful thinking. We don't control the markets. We just have to operate with what's in front of us and what cards are on the table. So here you have your 50 fib going back to March of this year. You can see that clearly. Again, more you look at these charts, I believe the more you'll be able to operate with some level of calmness and what should I say, accuracy. And if you're just doing the prices and not really understanding the charts or tracking the charts, you're going to be operating completely blindly. The market's already nuts. You do not want to trade blindly because it's going to drive you insane. Okay? And believe me, there's a lot of money to be made in the market, but you have to basically operate within the realm of these technical charts, which will make you a better trader, and at the same time, in my opinion, will keep you sane, because sanity is very important when you're trading. All right? It's just like war. You got to be sane. If you're insane, you're just going to kill your fellow soldier. You're going to, blue on blue. All right? You're going to just turn your M16 and shoot the guy next to you. You want to shoot the enemy. Okay? You don't want to be shooting your fellow soldier. So that's what insanity does, right? So you do not want to be insane. You don't want to be shooting yourself on the foot too often and doing stupid stuff. The market will make all of us do some stupid stuff. I've done a few stupid things over the last couple of days, but I have done less stupider things and smarter things in the last couple of days too. So that's the way it goes. Constantly try to keep on changing your behavior. So saying all that, so this is where we are. And this looks like we might test this gap here. We might do that. The sooner we do that, the better. I don't know if we'll do it because we already tested it a whole bunch of times. And that gap is here, shaded in light red here. And that is 2816, 2824. The only solace here from a standpoint of limited downside is your stochastics. If you look at the stochastics, it is now creating a double bottom. At least for now it is. So on the S&P 500, that's how it closed that today. So that's kind of positive. The first thing that catches my eye, it's created a nice double bottom, slip and sliding. It can create a slightly lower double bottom. We shall see. That means the market will retest this gap again. All mechanical, all methodical. And but whichever the case, once it gets this oversold, you generally tend to get a reflex rally. There you go. Right? Of this. Nothing. It's all mechanical. Nothing magical about this. So I look at the hourly stochastic resets, as we call it, resets from overbought to oversold, as a reasonably reliable indicator during any type of market, but primarily during these volatile markets, to see whether or not it's worth entering a trade. Next one, the longer term chart. This is where it gets a little tricky. All right. Now and I go on record, I still believe that the Trump administration and the trade team, they are going to hammer out a deal. The Chinese need a deal real badly, really badly. We need it too. We cannot, if we don't get any type of somewhat, let's just use the word, half-ass resolution of in this U.S.-China trade war, I can assure you no one is going to be a winner. Keeping all the political stuff aside, you see how the markets react on every single deal breaking news that the deal's going to go through. The Chinese premiers not going to meet. That's another thing. At the G20 meeting in June, I believe it's the end of June, President Trump has said that he would like to meet Premier Xi. That would be hugely positive. Now, there are reports out of Chinese newspapers. That's what they're supposed to do. That the Premier Xi is not interested in meeting him. I don't believe that for a minute. They actually have a pretty cordial relationship, Premier Xi and President Trump. Okay? And so the bottom line is that could be another very positive piece of news that hits the market, and the shorts are scrambling again. We have a 400-point up day. Don't write that off. So this is the part which gets a little bit tricky. And so the different ways to interpret it, I'm not going to spend the whole night to do it, but I'll leave it to you guys to look at it too, because your opinion matters too, obviously. So from a negative standpoint, you got a head, you got a left shoulder, and you got a right shoulder, which is roughly where the 34 and the 50-day moving averages are, right there. At this point, we are the 50 and the 30-day moving average, these things right there, they are starting to merge and cross down. That is not necessarily good. You see this 34-day moving average starting to cross below this uptrending. I repeat, uptrending 50-day moving average. That's not good. Number one. Okay, so that's a negative point. So what does this? But it's a slight crossover down. This one is not necessarily bad, the internals. It is still kind of doing this inverse head and shoulder type of move higher. Why is it important? Because stochastics dominate what's going to happen to the prices on the front side, on the externals. This was a V-shaped move back on March. We did get a V-shaped move. Bang, bang, bang. 3 days of massive gains. Stochastics moved up accordingly. Then it moved back down. Bulls will say, hey, that's an inverse head and shoulder. We like that pattern on the stochastics. So let's try to decipher the pattern. What's going on? Bears will say, yeah, it started to go up. Now it looks like it's going to come back and retest the lows again. In that case, we're going to come back and retest the lows at 2,800 again. So that would be the bearish standpoint. You got to respect both sides. Okay, you have to respect both sides. Remember, this is like a trade negotiation, trade war between the bulls and the bears. All right, the bulls just want, the bulls want things to move higher. The bears want to pull it down. So that's it. There's a trade war. So you gotta. That's pretty much what's going on. So at this point, upper end of this range is 2894. Rounded up, 2900. You can see that 2900. I had told you we would go to 2900. We hit 2,900 on the 16th of May. It did happen. Now, We got a pullback. That was an inside day where the body of the candle was still within the body of this very large green bullish engulfing candle, and things were looking good. And then bang, today this happened. So this is troublesome. One has to admit it. And I've explained to you the shorter term picture of what this means on the charts. 2800, 2900 on the S&P 500. That's it. This is where we are right now, which reaches up 6.5 points. So what we really need to see, very simple, candle dynamics, anybody can understand this. We need to see a bullish formation. Whether it starts off from slightly below, remember the tail is all the way down here at 2830 that I showed you on the charts. So even if we start lower tomorrow, let's say for example, for whatever reason, and then it starts turning around and we create a nice green candle, which doesn't have to be a bullish engulfing outside day where we start lower and then end up higher over this red candle. It can be within the body of this candle. It would be considered a win for the bulls. You can trade these things intraday. All right. You can't trade this chart intraday. You can trade the 15-minute, 1-hour chart. You can't trade a daily chart intraday. You can just get a perspective of where we are. So that's it. All right. So this is the little green candle with futures up roughly 7 points right now. So it's a mixed picture. Nothing, and I'm showing you the simplistic ones. I'm not even, the next session I'm going to show you on Wednesday is going to be totally on the quad algo HFT platform where this whole structures are far more detailed and all kinds of stuff. This is pretty detailed too, but those are really mechanical. So this is where we are. The lower end of the Bollinger is still showing at 2800. And this is the funny part. Despite all this dropping on the market, the upper end of the Bollinger Band, see how wide it got? Incredible. See how wide it got? It was just like traveling like this, and all of a sudden it just went bang. All right? So the upper end of it is still is at 2976. I'm not saying you go from lower Bollinger to upper Bollinger every single time. No, you don't. But I'm just showing you that the Bollinger Bands don't just appear as a cloud cover from nowhere. Read up the definition of Bollinger Bands, and then you'll understand what I'm saying. These are ranges that the market is operating in. So if this is the widest range the market's operating in, what the market is telling us, ladies and gentlemen, is that if we have some sort of resolution or some sort of ceasefire on the U.S. trade-China war, then the markets are going to go up, make a new high. That's what it's telling us. That's what the Bollings are telling us. If we stay status quo where we are right now, we are basically going to hover around 2800 and maybe slip and slide slightly below 2800 because so much bad news has been absorbed by the market, and we are still sitting here at above 2800 in the S&P and above 25,000, roughly around 25,700 on the Dow Jones Industrial Average, with so much thrown at the market. That's, there's a case to be made that the market is underlying strength is still extremely strong, of course. Next chart is your weekly. This is a weekly chart. Weekly chart, this is the thing that bothers me. The stochastics are still pointing lower. If I squint my eyes or slap my head, in the back of my head, I can see a little bit of deceleration on the downside momentum. You can start to see a little bit of deceleration on the downside momentum. Now I'm trying to, somebody say this guy's like, he's overthinking too much. No, I'm overlooking too much, meaning like I'm focusing too much, and that's my job. So if this is on the weekly charts, don't change on a 15-minute drawdown on the market, right? So if this is starting to even flatten out a little bit, you can bet your butt that we are going to get a 300, 400, 500-point rally coming imminently. If I see, as my mixture of technical charts that I track for all of you, is if I start to see a slight, and that's why I have an arrow here. If I start to see this flattening out a little bit, that's the first signs. And then the other shorter term indicators, the daily, the hourly, the 15 minutes, they're all going to be just, all the crossovers are just going to go lightning speed higher. So if the weekly starts to do this, the big word is if. I believe that it will attempt to stabilize at around this level. Why? If I'm using chart analysis like we do with stock charts, I mean with individual stock charts, this was a triple bottom dragon bullish breakout with a neckline right here. Breakout. This is where clueless A trading expertise comes in. If I'm right, and I have been right before, more often than not, is then this will stabilize at the neckline support. Remember, this was the neckline back on this humongous run up that happened after the Christmas Eve massacre, right? So if that's the case, these stochastics will retest as it's doing right now. Let's try to draw an exact line. So I don't have to, let's do this. Perfect. Okay. So bottom line is right there. It should be able to find support because it's a simple retest, not a simple, but a technical retest of this neckline breakout that occurred at around 54.28 right there. So if this starts to move a little bit like that, it will drag every single shorter term internal indicator higher and you'll get a surge on the markets. Now, what would it do to the outside picture, which are the prices that we operate in? Well, if you look at this picture, the bulls are going to say, hey, it still looks like a friggin' bull flag. What are you guys all moaning and groaning about? And I'm including myself moaning and groaning, the frustration of this the constant volatility, not knowing what, wake up at like middle of the night like I do sometimes, just like checking on the future, they're like down like 30, like, here we go again. This is still looking like that, as my good friend Fish Eyes knows, the galloping horse pattern, right? This is a galloping horse pattern. Still looks like a galloping horse, i.e. a bull flag. So the weekly is still exhibiting a bull flag pattern. Pretty incredible. If you count the number of candles on the weekly, and again, they say we were down 4 weeks in a row. That's the individual prices of the indices. This is the actual candle structure, which generally doesn't have to be read, can be read, and we can still have this was a positive week. This was actually a positive week, even though we ended down, because look at the massive long tail hammer reversal. This was a nice green doji. And this is the week we're in right now, started today. We are in a red doji. And you can see here that this is still a bull flag pattern within the context of a consolidation that started on at the end of April. Now, what is everything just, there's nothing really ever falls apart, but where does it technically fall apart? Let's put it this way, is if we break the mid Bollinger right there. That's why we have a red line here. This line is your mid Bollinger. That is around 2,800 again, 2,805. If we break that, then we have these two lines to contend with, where the last major rally started. That was in March. See that? March 4th, March 11th. And that is down in the mid 2,700s. The lower Bollinger is 2,600. I'm not going there yet. So I watch this very carefully to see whether or not there's any attempt for stabilization. There could be. But so far, the first visual that shows me on a weekly chart that this is still exhibiting a bull flag going back all the way down here. Okay, now, so that's your longer term picture. Now let's take a look at two other charts and we're going to wrap up, because I don't want to keep going on and on the same things, because it's good to give this precise, targeted, actionable, powerful information. You can absorb it, get to work on it tomorrow, and apply it. So this is your S&P SPX 533 chart. Now on this chart, the positives are these MACD histograms are shrinking. despite this two-day drawdown. Both dojis, by the way. One's inverted hammer that happened on late on Friday, the last hour, right? 3 to 4. Just a boom, they came in. And here's the manipulation in the market. They issued the news that the Chinese were not really interested in, and the media came out with it around 3 p.m. and the market started selling off hard. The Chinese really weren't interested in sitting with us till we got serious, according to them, on talking substantive issues. Well, guess what? That news was on my Twitter feed and public news before the market opened on Friday. So how come the market went up during the day, and then at 3 p.m., Ms. Kayla Tausche, the CNBC reporter, comes out and says sources have said that the Chinese are not really willing, not willing, but they're not really interested in meeting, and we don't, U.S. trade delegation and stuff, blah, blah, blah. Well, that's all news, rehashed. Yet the market reacted that way. Why? Because there was a heck of a lot of big, fat institutional margin calls that needed to be satisfied before the weekend started. Because someone always knows, right? They knew that we were going to go out there and slam the brakes on Huawei, which was also old news, the networking company, and also Google and so many other companies have stopped doing business with them. So that's, so whatever the case. Anyway, just want to tell you, this type of manipulation is outrageous. That's just the way the markets work. So let's look at the positive. The positive is these histograms are shrinking. Generally, when they start to shrink, they tend to go positive for a couple of days. These are big moves. So let's see what happens. This, we were moving up. We were moving up nicely. We were here on Friday, and then now we landed up here today. So if you want to look at this is still looking like a cup and handle. See, with charts, you just can't make up patterns. You got to go with what's in front of you. I'm not saying they're bullish or whatever, but this to me is still looking at a cup and handle right there, this particular part. So if that's the cup and handle, you got the 2880, 2890 level, which is the neckline. You could break out over into the 2900 level. That's roughly 600 points from here. That could happen for reasons I just explained before. A quick announcement that President Xi and President Trump, Premier Xi and President Trump are going to meet at the G20 meeting. The market's going to frigging jump 200 points in 10 minutes. This is positive. This is positive. What's the negative? We still are not fully oversold. It gets this dark here, deep oversold. RSI gets to its 10, you buy, and it jumps every single time. Every single time you get a protracted over RSI staying over 80, that means you get a extended rally. Same thing with stocks. So that's your SPX 533. Now let's take a look at the weekly. The weekly chart is I don't want to get people too confused. The weekly chart on this one is looking like crap. It's looking like crap. The histograms are piling in, are shrinking hard. Look at that. So where's somebody says, well, show me where the light is at the end of the tunnel. The only thing I show you what the light is at the end of the tunnel is that we are this pattern-wise, this is a falling wedge with the lower end of the wedge in the low 2800. So it's still got downward pressure. The other light at the end of the tunnel is we are at 10 RSI on the frigging SPX 533. That's unheard of. So once it gets to 10, it doesn't go to 5. It generally starts to get a little bit better. That means this will move higher. So that's your light at the end of the tunnel on the weekly. But at face value, the shrinking histograms, no bueno. All right? And that's why the weekly, that's why we are monitoring and tying this up with this chart. We are monitoring this. Does it break down below or does it flatten out? That's the $64 million question. If it breaks down, that means the market is overall bias is lower. The last chart, which will cap this thing, is our one of the most powerful charts, which is your indicators, I should say, the internal, the hidden picture. There's a bunch of them, but this is one you use quite often, is the New York Stock Exchange McClellan Oscillator, NYMO. So the NYMO, as my good friend Fish Eyes here is an expert on the NYMO. If you look at the NYMO here, you're going to see that you literally buy with hands down when it falls in that 60 range. See that? See that? It is almost a 100. I shouldn't say that. That's terrible. Let's say it's a 95% probability that you are going to get a vicious bounce when you get to this level. We closed here on Friday, minus 23. We're at minus 40 today. We could get to minus 60. That's why we have a couple of those SPY hedges in place, just in case. If we get to minus 60, you are going to get an instantaneous bounce back in the market. Will it get there? No idea. Showed you all the possibilities of what can happen. It goes to minus 110, like on the Christmas Eve massacre on the market. Wow, that's like the most horrific time. People are just like, oh my God, never want to ever look at stocks. Even out there now, people are like, I don't want to look at stocks. Forget it. Look at the chip stocks. Look at that. I don't want to buy stocks. I mean, give me a break. Stocks, what are they? At one point, it's going to be a stocks. What are they? That's when you want to put all your money, every single penny that you have in the market. But the point is that these are extended 63, 41. This is where we are today. This is updated to today's chart. These are deep, extreme oversold levels. So from a technical standpoint, oversold leads to a oversold dead cat. That's what they call it out there. We call it reflex bounce. Now, if the monthly charts are still going down and the market wants to still go down, it doesn't matter. You can play those interim vicious rallies. Remember that old saying, the most vicious rallies on a short-term 24 to 48-hour basis happens within the context of a bear market. We're certainly not in a bear market, but I'm simply saying that when sharp drops happen and everybody's fleeing, you want to be setting up at least some trades for the counter move. Okay? So bottom line is the counter trend move. So minus 40, minus 65. We're not at minus 65. At minus 65, gotta buy it. Gotta buy. Hard. Minus 40, you gotta buy too. So these are extreme oversold level. This, I've been noticing, this is your MACD. The MACD crossover still remains. This MACD crossover is still crossover up. You can see that. Okay, right there. Focus on this. Despite the dropping in the market, this crossover up is still intact. Crossover ups always lead to a powerful reflex bounce. The last chart I'm going to show is your two charts, as in finding a safe haven in the market. That's what we try to do, right? So here's a winning swing chart. I mean, we should have taken like everything we had and just put it into United Healthcare and said, manage my care, right? Like manage my P&L, just take it up there. Well, this is your take it up there type of chart. I've been trading the stock consistently since it hit this level. This was the Bernie Sanders, let's go full scale, full blast, Medicare for all comments. Okay? And comments, mind you, also from President Trump, we got to control drug prices. I mean, come on, this and that. I mean, they're terrified out there in the healthcare land. They're like, what the hell is going on? Okay? But this was the Bernie Sanders fallout. Before that, it was attacks coming from the Trump administration on drug price control and this and that and that. They just couldn't take it anymore. They're like, what the hell? Just sell the whole crap, right? So that's what they did. This is a very technical chart, very easy to read. Upper end of the zone is 253. you still have room to move. And today, after this whole move, you get Kramer talking about it after this whole move, right? And we've been talking about it all the way from here and telling people to buy it. And you got other people writing about it. Like these, it looks like they're the best stocks out there in the market. Well, dude, what were you guys like, telling us to buy it at 210, 220 at Clueless Day Trading? We told people to do it. So I don't need to easily pat myself in the back. This is what we do. So this is a good looking chart. And we have it is basically at pattern completion zone. I believe the stock can go to 260. Got 15 points on it. Because at this point, shorts who shorted the stock on the Bernie Sanders crap about just killing our managed care industry, it has recovered almost all of it. So once it crosses over, you get a big fat short squeeze. Even on a day like today and many other days, it's glowing green. Stock's up 2%. The options are up more than 100% plus. So this is your safe havens, guys. Okay? So you got to focus on these. I'm not saying forget the Googles and this and that, There was another piece of good news that came out that they never talked about because the media loves to talk about bad news all the time, right? That President Trump's team were looking to give a nice amount of exemptions to Huawei. Huawei? I gotta learn how to pronounce that company. It's one of the world's largest 5G, telecom producer, equipment producer. So anyway, Huawei, that they were going to give some exemptions because there's a lot of companies here which depend on it. Verizon, some of the rural companies apparently depend on Huawei equipment for networking. We've been doing business with them for a long time. So the thing is that they were looking to give some exemptions so U.S. companies could still buy products from them and we could still sell some stuff to them. But they didn't talk about that. So bottom line is that let's talk about this here. You have the big channel. This is your daily right there. This is a good looking chart, whichever way you slice it or dice it. Aside from another attack on managed care companies by any of the parties, in that case, that's a different story. A breakout over the 250 level will project the stock higher. It can go to 260. Believe it or not, it can go to 270 and complete the entire pattern. Entire pattern. 270. That's a lot. You wouldn't even give a crap whether the market was down 3, 4, 500,000 points if you were sitting on stocks like this. That's the funny part of trading. If you're in the right type of stock, let's say you have most of your money in the right type of stocks, or and you didn't have to deal with the crap of the S&P going like upside down, inverse head and shoulder, inverse whatever, head and shoulder and all that crap. You'd be like, oh, what's wrong with the market? I'm sitting on this and this. So that's what happens. Okay. So focus on UNH. The next one that I asked you guys to put some money in is Humana. This has more potential. Now, United Healthcare is obviously a more powerful company. I think. I'm not really a specialist on managed care. So this one's great. This is in the same field. Humana. Look at this. It hasn't even started to make the breakout over the 50-day moving average. The 50-day moving average is 259. That's 9 points higher from here. Another point. And as I've mentioned to you guys before, this has no frigging China exposure. China can tariff the crap out of everything. What, they're going to tariff the crap out of our HMOs? Keep that in mind. Okay, 50-day at 22.59. Damn good looking chart, if you ask me. Now, the biggest risk to this is political risk. The Bernie Sanders of the world, somebody from the Trump team, or President Trump tweets out, like, we want we want to cut back prices on HMOs and stuff. Oh, well, that's a different story. Those are political risk. But technically, it's damn good looking. So the political risk is we have to deal with when we deal with these the healthcare sector in general, drug price control and all that stuff, and the HMO. But so far, looking good. The other one is Anthem, ANTM. You've seen me put that out a whole bunch of times. Anthem. Look at the daily chart of Anthem. Okay, I got to adjust the lines and stuff a little bit. And this one is another one, which one should keep an eye on. Fell apart from 317, back and forth, complete crash. This is the Bernie Sanders crash from 290 all the way down to 230. Anthem Health, and they're good. And now they're doing this. And this one has a 50. It's the 50-day moving average is 275. Remember, eat what you kill. You get 6-7 points on a stock on a bad day in the market or in a good day in the market. You're up 60, 70, 80%. These options are not the delta and the gamma and the theta. They're not as volatile as like the Google type of options and stuff. So they tend to move a little bit slower. So what? So they'll give you a 60, 80% move. Great. Take it. So 50-day moving average 276. So there are three stocks. Then there are other stocks. I'm not going to sit here all night explaining that. This is a good looking chart, right? Sorry, Wayfair is actually a pretty good looking chart. I'm going to start looking at that. We played that on earnings. And what was I going to show? Zillow, right? So this is another good looking chart. Yeah, small mover. So what? It moved from 30 cents to 60 cents. That's 100% of the money. These are the June 21 45 calls. What's 60 cents? It went to 75 cents from roughly 30 cents. It's like a $30 call or a $3 call going to $7.50. It's not a crazy fast mover. It'll move like $1 or so. Options, unless you have a bunch of them, they'll move like 20 cents. You're like, it just got two, or no, just, whatever. You got a couple and it's like move 20 cents. It really doesn't do anything. I know. So you got to buy a bunch of these. So this is another good looking chart. So guys, I'm just going to wrap up today. I think we covered some really excellent points. Just focus on things. I know it sounds like a broken record, but you really got to focus on the charts. I know many of you are. Hopefully we'll have a better market environment going forward. I do believe, like I repeatedly said, this is Memorial Day weekend. I've always said this for many, many, many years. Don't try to overshort the market on Memorial Day weekend. On that note, God bless you all. You guys are fantastic. Thanks for attending, and look forward to better days. Less volatility. That's what I mean. Less volatility. God bless you all. Good night.